Hello, and welcome to the next edition of the Capital Stewards podcast. In this episode, we're going to talk specifically to leaders that are investing and working on behalf of organizations. So, if you are on an investment committee or you help manage an endowment or a trust or something like that on behalf of a faith based nonprofit or some other organization in your community, a lot of times you may feel sort of a unique challenge that comes along with that. And increasingly, we're starting to get a lot of questions from folks that are in those circumstances because they feel like it's different than investing for retirement. They feel the weight of stewarding the generous gifts of folks from their community, from their congregation. They understand that that's a high calling and there are some unique challenges there, but they're not sure what to do, how to approach it, how to deal with working with other folks in the investment process. It's not just sort of them investing for retirement, but oftentimes there's multiple people involved in those organizations. So based on some of our experience working with faith-based nonprofits and organizations, we'll talk about how you should be approaching the investing on behalf of your organization. And there's 5 kind of common challenges that we see that we're going to address in this episode. The first is the governance structure. How do you have an investment committee? What should that look like? How do you get all these people that don't invest the same way and think the same way to work together? We'll talk about what's really important from an investment standpoint. How do you build a plan and figure out what your goals should be and invest according to that, as opposed to just sort of on the whims of who's on the committee this year and the next year it changes. And if you've been in an investment committee, you've seen that problem before. So we'll talk about that. We'll talk about high fees and transparency, making sure that you understand the cost of investment management and how much of your organization's money is being spent to manage the portfolio versus earning returns and then being able to be used on great things that your organization's doing in the community. And lastly, we'll talk about performance tracking and how you should evaluate whether what you're doing is working or not working, and how you build confidence that your investment plan is going to deliver on those goals that you set out to accomplish up front. So those are the 5 kind of common challenges that we see, and we're going to talk about those in this episode in more detail. So let's dive in. So the first challenge when you're investing on behalf of an organization is what I call the slow as molasses governance structure. Oftentimes, governance is simply sort of a board or a group of people from a broader board without a whole lot of formal investment decision-making experience, right? Maybe they've never worked on behalf of another organization and invested that way before. Some of them invest in their own personal life. Some of them hire professionals and they understand what investments sort of in a professional environment should look like. Others are kind of do-it-yourselfers. And so your portfolio might have some bias towards some things that they're doing that may or may not be good. And those things may or may not be repeatable. And so one of the most important things that we see, and frankly where we start a lot of times with new organizations that we're working with, is making sure that the governance structure is right. And that starts with having an effective investment committee. So how do we build an effective investment committee? The first thing, like most things in life, is to start with a plan. A lot of times, the investment committee is a group of guys and they get together and they're like, well, we should invest a portfolio. How are we going to do that? You've got to think about how the group is going to work. What's the plan going to be? What is the organizational structure that's going to help make decisions? The first thing is to think about what is the role of the investment committee? What is the role of perhaps an organization's finance committee or the board? What kind of decisions are the folks that are charged with managing the investments able to make? When do they have to go back to the board for approval? And so it's important to understand what decisions that group can make. And then secondarily, the next thing to do is to figure out how they're going to make those decisions. So a lot of times we see things like 2/3 voting strategies or something like that. How are you going to decide on an investment strategy and then make decisions as you're evaluating performance over time, and do that in a way where you can sort of get the group moving in the same direction, right? Because again, you might have diverging viewpoints. You might have an economy that's moving in one direction, and some folks want to invest one way, and other people want to invest another way. And how do you deal with some of the dissent that happens naturally in the process? And so it's really important that you think about that ahead of time as you're establishing the committee. How are we going to make decisions? How are we going to get everybody on board? Is there going to be a voting process? Does everything have to be unanimous? How do we think about those things and document those and get those in front of everybody so that coming into the investment committee, everybody understands, hey, this is how this group works. These are the decisions that we are charged with making and the sort of level of authority that we have. And here's how we're going to make those decisions, and here's what my sort of input into that process is going to be. I like to use a quote from Kenneth Dayton when we talk about sort of the investment committee. Governance is not management. So governing endowment or sitting sort of on the investment committee is not the same thing as providing day-to-day management. So if you're sitting on an investment committee and somebody is picking stocks or doing something like that, that's not really the point of an investment committee. It's kind of like thinking about the distinction between the role of the board of an organization and the CEO. The CEO is running the business day to day. The board of directors is providing oversight, strategy, guidance, those kinds of things. So the investment committee should be focused on connecting the investment portfolio with the organization's strategic goals, developing the asset allocation, which we're going to talk more about in a minute, reviewing performance, making sure that we're achieving the goals that we set out to achieve, not sort of doing the day-to-day work of rebalancing and choosing investments and deciding whether we like this fund or that fund or this other thing over here that someone brought. Just a couple of tips on having sort of effective investment committee meetings. I think a lot of times these meetings can sort of drag on. They take a long time. Nobody wants to do them because it's inevitably on some weeknight at 6 o'clock in the evening and everybody's worked a full day and they're tired. So just a couple of tips on having an effective meeting. You want to build the meeting agenda in advance. Build the agenda, have your investment manager send materials to everyone so they can read it ahead of time, so that they're not spending the time that you've got together, that hour and a half in the investment committee meeting, getting up to speed on what's happening. You can focus on how we're doing, what are the issues, what's the strategy, are we achieving our goals? You can get right into the kind of the meat of the discussion. We also recommend kind of a deep dive approach, right? So instead of covering everything in every meeting in your portfolio and revisiting your asset allocation and your strategy and all of your investments, split things out and go deep into particular parts of your investment policy and particular parts of your investment portfolio in every single meeting. That'll allow you to take a deeper dive into certain areas of the portfolio. You can do that in a way that's repeatable throughout the year, throughout sort of a meeting calendar or a meeting cadence. And it'll help you avoid sort of short-term thinking where everybody kind of brings their hot topic that they've heard about in the markets, and that's what dominates the discussion. What you really want to do is use your investment policy, use your portfolio, let those things be the guide, and make sure you dive into those things over time. How long should the meeting be? I think it depends for every single organization. I think the right answer there is how long does it take with a focused agenda to make the decisions that you need to make? And secondarily, how long will your members stay actively engaged? If everybody starts zoning out, then that's not going to be particularly effective, just like any other meeting that you've ever done, right? Blabbering on, which is a technical term for people losing focus, doesn't work well. So in our experience, if your committee meets 2 or 3 times a year, then maybe it's an hour and a half to 2 hours. If it's more frequently than that, then they can have shorter meetings. But I think a couple of hours is kind of the max on any session because people start to lose focus and they just want to move on to other things. So to kind of wrap up the conversation on governance, it's really important to define going into the process ahead of time. What is the role of the investment committee? How does that fit in with the board and all the different types of structures that are in your organization? And then very clearly lay out how your investment committee is going to work, how the meetings are going to be structured. Keep those things short, keep them concise and to the point, and don't get stuck sort of on market hot topics and things like that. You can use your investment policy statement as a guide when you think about how to structure those meetings. The second major problem that we run into is a lack of focus on asset allocation. If you've listened to me talk or you've heard other folks in the market talk, you probably have heard that asset allocation is really important. And asset allocation is just a big finance term for the percentage weight you have between stocks and then between other stuff in your portfolio. So how much do you have in equities? Then how much do you have in what we call diversification and income? So bonds, real assets, commodities, all those kinds of things kind of fall into that bucket. If it's not an equity, it kind of falls into that diversification and income bucket. So what's the percentage split between those things? And then you can go one level deeper into that. And then on the fixed income side, what's in bonds, what's invested maybe in gold, or what's invested in real assets and other types of things. So getting the asset allocation right is the number one most important thing when you think about your investment results over time. Being invested in the market and then having the right asset allocation is going to determine, more than 90% of your investment results. So if you're spending a whole lot of time on which stocks do you own or which particular funds do you have or active versus passive, all those kinds of things, that's that last 5 or 10% of your returns. 90% of the work is what is the right asset allocation and sticking to that asset allocation and staying invested over time. So if you're investing on behalf of an organization, you need to think about, what is the right asset allocation, and the key decision from our perspective on what that investment committee is charged with making is what is the right asset allocation, and then sticking with that asset allocation over time. Underdeveloped investment policy. So this is the third thing that we find almost 100% of the time when we start working with new nonprofits, endowments, and foundations. Your team probably does an excellent job at planning to fulfill your mission, whether you're a church and you're trying to build your church and grow your congregation and share your faith in the community. If you're a nonprofit, you're trying to help people that are marginalized in society. Whatever you're trying to do as an organization, probably really good at trying to do that. And then the investment plan, with all the resources that we have as an organization, is sort of like the invest in hope method. It's kind of like, well, we have this money and we hope it's going to do well. And if it doesn't do well, we're going to be in trouble. Large institutional, sophisticated investors do not invest that way. They have a well-documented investment policy statement that has particular goals and objectives, right? How much income do we need to generate in order to be able to accomplish our strategic plan? Is this money sort of set away for a rainy day and we need to really protect it over the long term? Or do we want these assets to grow and potentially be able to be used to expand and grow our organization long term? So having an investment plan is super key to developing the right asset allocation, right, that we just talked about, because how much risk we're going to take, what percentage we're going to have in equities, what percentage we're going to have in bonds. A lot of that is determined by what's our goal, what kind of return do we need to generate from the portfolio every year. And if we don't understand those things, if we don't start with goals and objectives and what we're trying to do, then we're just sort of investing and hoping that it goes up and then hoping that the assets are going to be there if we need them one day. And that's not a particularly effective way to invest over a long period of time. When you have a plan, by the way, it makes it a lot easier to stick with the program when things aren't going well, because you'll have some really good years and your returns will be great and they'll be way over what you expect. And you say, okay, great, we're doing really, really well, but we're sticking to our plan. We're only pulling out a certain percentage of the returns every single year. And then you have those bad years that come along and things go down and you say, but it's okay because we outperformed in some, in the years prior. We've got the resources that we need to be able to still take withdrawals from our portfolio and use it to support the mission of our organization. And so it's really, really important that you build a plan, you think about what return targets you're going to use, what kinds of withdrawal targets you're going to use, and how you're going to shape that into an investment policy statement that you're going to use across market cycles. The fourth problem that we see a lot is a lack of transparency. So a lot of times, if you are working with a consultant or with a broker or something like that, you may be paying more, for your investment management than you think. And this is common for all investors, but it happens a lot of times, I think, with institutional portfolios, with nonprofits and endowments, because we're just paying less attention maybe than we are on the personal side. Core US large cap stocks investment should cost less than 5 basis points or 0.05%. Our kind of view is that portfolio management, consulting, and the underlying investments, all of that should cost less than 1.25%. You can get everything all in for below that because it doesn't cost that much to get core exposure over long periods of time. A lot of times we see portfolios that cost 2% or more when all the fees are considered, because we've got a management fee and a consultant's fee, and then we've got expensive mutual funds or other types of portfolios that are in there. And you add all those things up, and that's hundreds of thousands of dollars that aren't being used for your organization's strategic goals and that are going to your investment managers. That means that staff aren't getting hired, programs aren't happening the way they're supposed to happen because fees are simply too high, and they don't have to be. You can invest on behalf of an endowment or a foundation in a way that is low cost and accomplish your goals. And so it's really important, one, that you understand what the fees are, right? So a lot of times folks don't even understand what the total cost of the portfolio is. So what are we actually paying for our investments? And then two, is that number appropriate for the goals that we've created, the investment policy statement that we've created, et cetera? The fifth and the last thing is a lack of performance tracking. So forget poor performance or underperforming or not achieving our goals. Oftentimes we work with organizations and they don't even know what their performance has been. They're not comparing their investment performance with the appropriate benchmarks. So are you receiving value for the management fees that you're paying? And in order to do that, you've got to have a view of performance. Now, traditional sort of investment management performance reporting is sort of the return of your portfolio against the benchmark, and that's important. But in addition to that, think about investment performance through a triangle. What I mean by that is that the first point on the triangle is the goals and objectives. Are we accomplishing, from an investment management perspective, the goals and objectives that we set out to accomplish? The second part of the triangle is the long-term returns that are in that investment policy statement. Are we achieving those returns? And again, not every year, right? But if we've got a target return in there, are we achieving that over long periods of time on average? And then the third part of that is the portfolio performing or exceeding the return of the benchmarks that it's benchmarked against? So we know that we're achieving our goals and the folks that we're working with are adding value. And that comprehensive view is what allows us to know that we're on track to be successful. The reason that we evaluate performance is not so that we can say, hey, are we good? Are we bad? Are the folks that we're working with, are they good or are they bad? But it's, are we on track to accomplish the goals that we set out to accomplish as an organization? So I hope this conversation was helpful for those of you that are leaders that are working with organizations, churches, other kinds of faith-based organizations, and are sitting on investment committees. Hopefully this helps you understand some of the differences in managing those portfolios and some of the challenges of working with investment committees, and give you some tips on how to manage that, and then also helps you give you some things to look for when you think about approaching the investment management for your organization. Again, those 5 things: the governance structure, getting that right, focusing on asset allocation, making sure you've got an investment policy statement and a plan, and then looking at fees, making sure that you've got transparency, making sure the fees are appropriate for what you're paying, and then make sure you've got the right performance structure in place. So those are the 5 things to look at if you're investing on behalf of an organization. And hopefully this conversation will help equip you to be a better investor on behalf of your organization. We'll look forward to talking to you in the next episode.